Okay, so in Chapter 10, we're going to be talking about performance evaluation, and the first thing we're going to discuss is the concept of decentralization. So again, objective number one, we're going to talk about what decentralization is and the different types of responsibility centers that can be created. Okay, so the concept of decentralization is when you basically split up your operations into different types of performing segments, or they call operating segments. Advantages when you decentralize is that in a way you're delegating, you're freeing the top management. They don't have to, per se do all the decision making. You're also transferring or spreading out knowledge, so you're basically using more experts, you're getting more feedback, and because there's more involvement of the middle management, you should have better customer relations. And also the fact that if you're middle management, it should increase motivation because now that your decisions are actually going to matter and make differences within the company. Sometimes though, if too much is decentralized, some of the disadvantages is sometimes you have some duplication of cost. And sometimes if you don't promote what the objectives are, sometimes you could have potential problems in actually meeting the goals of the particular organization. So again, a proper performance evaluation system should provide the upper management with good feedback. And then for this to be effective, performance evaluation systems should, of course, you always have to have good communications. So you should always clearly communicate what you're trying to achieve. There should also be proper benchmarks should be set up, and of course these should be communicated so that you can actually meet the goals. And then hopefully that this would also help to motivate these managers. If they can meet these goals, then obviously you would have some sort of reward structure set into place if they can actually meet these expectations. All right, so in a decentralized environment, typically you're going to have what they call responsibility centers and then some sort of responsibility accounting system to be able to evaluate these centers. And so what the responsibility center could be, it could be a profit center or a cost center. And what you're going to do is you're going to assign some sort of manager that's going to be accountable for all the activities of this particular center. And then of course you want to have some sort of accounting system like a budget system in place where then once you look at the plan, you can evaluate the plan and compare the actual activities, and then that's going to allow you to evaluate performance, and hopefully it'll help motivate, improve efficiency, and make the company better. So like I mentioned earlier, the types of responsibility centers you could create are what they call cost centers, where you're typically looking at the company's cost. You also have revenue types of responsibility centers. You could then have the profit, you combine the revenue and the cost aspect of it. And then you could also look at different types of investments that you want to make within the company. Okay, so the next thing we want to look at is the type of performance reports that is going to allow you to do these evaluations of performance. Again, this kind of relates to, again, the responsibility type of accounting. So what these performance reports basically do, and remember this is all internal documents, is what you're going to be doing is comparing the actual results, whether it's revenues, expenses, or profits, to some sort of budget. So remember the budget is some sort of plan. So, and that's going to be basically the goal that you're trying to achieve, or in some cases beat the budget. But you compare the actual results to the budgets, and then at that point you're going to get variances. The variances are any differences between these actual results and the budget. And of course, you want to get favorable variances. That means that you're better than the budget. If it's going to be unfavorable, that means that you did not perform up to the budget. So remember, the budget is basically the standard. That's the benchmark. You're trying to beat it. And then of course, the other idea you'll look at is something called management by exception. And that's when you look at these differences and these variances, you're only looking for any sort of large variances that stand out. You're not going to look for all the minimum, the tiny differences that don't make differences in decisions. But management by exception, typically you're looking at the big differences that could have impact on decision making. Okay, so as you look at this illustration, we're looking at revenue variances, where what they're doing is they're basically comparing the actual sales to the budgeted sales. And in this case, you would want the actual sales to outperform the budgeted sales. So when you look at the differences and you look at the variance, again, you want the actual to be more. So for example, on these sun chips, you'll see that the actual sales were less than the budgeted sales. So they put that the variance was actually, well, they put a U that's for unfavorable. Then if you, for example, look at the Doritos, they had 15,896. The budgeted sales was 15 million. You outperformed the budget by 896,000. So they put the letter F. That means favorable. So This is what you do. This is how you look at the comparisons and start to evaluate performance. You can also state the variance as a percent of the budget. So on this column where you've got the variance percentage, what they did was they would have taken the 32,800, that was the variance, and they would have divided that by the budgeted sales of 2.4 million. So this is where they're getting these percent, how much you are favorable or unfavorable by a certain percent of the overall budget. So another idea you're going to come across is something called a segment margin. What the segment margin is, it's basically operating income generated by a profit or investment center. So it's once you've set up the responsibility accounting in terms of different types of centers, whether it's a profit center or a cost center or an investment center, what you can do is you can look at the operating income by segment margin. And of course, this is before you subtract out the common fixed costs. Common fixed costs are basically what they say is they're unavoidable costs. You cannot control that if you're a manager. It's costs that's basically be incurred, that whether you are in charge of the margin or a profit center, it doesn't matter. You're going to incur those costs either way. So a common fixed cost could be, for example, like depreciation, something you can't get rid of. So you want to look at anything that you can control. So I like to think of this as controllable income. And then at that point, once you look at these segment margins, you can then start to evaluate performance. So again, if you look at this illustration where they're looking at a profit center, they're comparing the actual results to the budget. And if you notice, this looks just like your CVP income statement. Notice what happens is you have your sales revenue, you've got all of your controllable variable cost, you then subtract out any direct fixed costs that are only associated with that particular segment. Then you get what they call the segment margin. This is your income. And then when they deduct what they call the common fixed expenses, these fixed expenses would be incurred regardless of these individual profit centers. So you want to separate out those. So the actual operating incomes where you get 409 and 400, the actual numbers you're really looking at for comparative purposes would be the number before you include the common fixed expenses. And you basically just go line item by line item, and again, you're trying to beat the budget. So for sales revenue, for example, notice sales revenue is better than the budget. The difference is a favorable variance. If you look at the variable cost, remember you want your cost to be less than the budget. So in this case, you have variable cost of goods sold that is actually more than the budget. That's why they say that is going to be unfavorable. And then for your variable operating expenses, notice you had 508 versus 515. Again, that beat the budget, so that's why they put the favorable in front of that. So again, you want your costs to be lower than the budget, and you want your revenues to be more than the budget. So if you look at this variance column, this is where they come up with the favorable or unfavorable variances, and then at that point, you could then do your analysis. But remember, the segment margin is essentially your profits before you deduct the common fixed expenses. The common fixed expenses, again, would be incurred regardless. So those basically, I would include those to be non-relevant types of cost. Okay, so for objective 3, we're going to look at the calculation of ROI, which is return on investment, sales margin, and capital turnover. Okay, so typically when you have these investment centers or responsibility centers, you typically manage it just like you're managing a company. So the manager who's ever assigned to that particular center is going to basically perform just like the CEO. And the way they're going to assess performance, one of the approaches is you can do what is called the return on investment, and then you can also look at residual income. You'll find that sometimes that the return on investment, sometimes it could be, if the manager is looking too focused on his or her particular segment, sometimes it's not always in line with the company's goals. So you might see something come up later on as you're reading where it talks about ROI, and they talk about this thing called goal congruence, where sometimes ROI doesn't always help you achieve the overall goals of the overall company. You may only look at specific responsibility centers where ROI is effective. Sometimes it misses the goal of the whole company. Sometimes you'll find that this residual income is a better measure of the overall performance of the company. Okay, so for the return on investment, again, it measures the amount of income relative to the size of the asset. So how much income is being produced by the assets. So the actual formula is what you do is you take the operating income and you're going to divide this by the total assets. Now, on the next slide, we'll show you an alternate way to also calculate ROI. Okay, so another way to calculate return on investment is you can do what's called taking your sales margin and multiplying that by your capital turnover. So sales margin is simply defined as taking operating income, dividing that by your sales. That's called your sales margin. The capital turnover is defined by taking sales divided by total assets. So notice this is an alternate way to calculating ROI. If you were to multiply the sales margin by the capital turnover, you're also going to result in your ROI. If you look at the formulas and you look at how they're multiplied out, if we were to cross multiply and then you cancel out the denominator, watch what happens. So operating income divided by sales times sales divided by total assets. Notice what's going to cancel out is when you multiply these together, the sales cancel out. So at the end of the day, what you end up with is operating income divided by total assets. And if you go back to the previous slide, that's the formula for ROI. Okay, so if you look at this illustration on calculating ROI, notice it gives you for three different divisions, three different segments or products of this division. You've got the operating incomes listed, and you've got the assets, and you've got the sales revenue. Now, if you're going to calculate ROI for each of these, if you just go back to the basic formula, you could just take operating income divided by your assets for each of these, and that's going to give you the ROI. Now, you can also do it the other way, where you can calculate the sales margin, which is taking your operating income and dividing by your sales, and then doing the capital turnover, which is basically your sales divided by your assets. And then what happens is when you multiply those two, that also gives you ROI. Now, on the next slide, we'll show you both calculations and how you really get to the same answer. So here is, the answers to the previous illustration, and what you wound up with. If you look at the sales margin, you take the 5720 divided by 22,000. Then you got the capital turnover, again, which is 22,000 divided by the 10,000. And remember your formulas. So again, I'll write these out. So for sales margin, it's operating income divided by your sales multiplied by, and for your capital turnover, it's your sales divided by your assets. And so what happens is for each of these, where you're going to take sales margin and multiply that by the capital turnover, what basically happens is the sales cancels out, and that's essentially your formula for ROI. The ROI number happens to be for each of these, for the functional ingredient is 57.2%. For ROI, it's 25. For the consumer markets, is 25%, and for the performance markets, is 26%. Now, rather than taking your sales margin times the capital turnover, because they gave you operating income for each of these, operating income, for example, for the functional ingredients was 5720, and we know that the total assets were, I believe it was 10,000. So you could have just divided those directly as well, and that would have been the same way to get to your ROI. Okay, now residual income is another approach to assess performance. And what this happens is it looks to see if where the division or the segment has actually generated any excess income above management's expectation. So you'll find that typically this is going to incorporate some sort of target rate of return. It's going to be a little bit more in line with the company's overall objectives. And the basic calculation is right here. Residual income is you take that operating income minus whatever your targeted return was, whatever that minimum number was. And typically what they'll give you is some sort of percentage times some of your assets. You take that income, subtract the rate times those assets. Any difference above that target is, again, it's called your residual income. So if we look at this illustration, you'll note that we've got, in this case, two divisions. You've got snow sports and non-snow sports. They give you sales, they give you operating income, they give you total assets, they give you current liabilities. Notice they tell you that there's a target 13% rate of return. It says refer to the data to do their residual income. So remember, your residual income is going to be basically your operating income. What you do is you subtract out whatever your target is, your targeted profit, targeted return on that particular segment. The difference is called your residual income. So in this case, this 13%, what you'll do, for example, for the snow sports, is you would take that 13%, you're going to multiply that by the total assets of $1,900,000. That'll be your target. The operating income of snow sports is $950,000. So what you would do is you would subtract that. Any difference would be your RI. Same thing for the non-snow sports. Again, you take the 13%. You're going to multiply that by 7,100,000. And the operating income was given at 1,482,000. You would subtract out that, and again, that would give you any RI for that particular division. Now on the next slide, we'll show you the exact amounts. Okay, so here's the snow sports. Notice here is your target. Like I said earlier, these are your total assets. That was your percent return. So once you figure out what this amount is, you deduct that from your operating income. RI for snow sports turns out to be $313,000. For the non-snow sports, the same thing. Here's your rate times your total assets. Once you subtract that from operating income, you would get a residual income of $559,000. And like I said earlier, residual income really is more of a goal congruence with the overall company because you are factoring in the company's overall target return. ROI doesn't always do that. And again, I'm not saying ROI isn't effective. I'm just saying sometimes you might get certain segments or certain individuals that may not be actually following or congruent to the overall company as a whole. And so sometimes ROI gets away from that. Residual income, though, because it does incorporate the overall company's goals, it sometimes enhances that goal congruence. Okay, so for objective 4, we are going to look at more performance evaluations. We're going to be looking at the flexible budget and how it compares to the master budget. So again, you've already done a chapter on master budgets where you had some sort of static sales number and then you predicted production, material costs, and all that kind of other stuff. Well, with the flexible budget, what happens is you look at not just one static level, you look at a different level of volume. In fact, you're going to actually look at what you actually achieve in volume and then use cost behavior to make your expectations. So what's going to happen is when you do these flexible budgets based on different volume levels, you're going to basically compare those to that master budget, which was a static level, and then look at any differences that fall out in terms of revenues and expenses. And you're going to find that the flexible budget is a much better comparison when trying to achieve performance. The master budget, whenever you compare master budget to flexible budget, when they're talking about this apples to oranges comparison, what happens is you have different volumes because the master budget is based on some sort of static volume, whereas the flexible budget is going to be based on a different volume, whether it's an actual volume or something else. So because volumes can change variable cost, you're not really getting a very good comparison for your variable cost. So later on, you'll find that when you're doing comparisons, the master budget, when you compare it to the actual activities, it's okay for your fixed type of cost, but it's not good for variable just because of that volume change. So if you look at this illustration, they put 3 things up. They put the actual results in one column, they put the flexible budget in another column, and then they put the master budget in yet another column. And like I was commenting on the previous slide, you'll notice, look at the volumes. In this case, it's based on sales volume. Look at how actual and the flexible budget have the same volume, but the activity on the master budget is a different volume because that was a static number. That's what was the original prediction. So all these numbers down here below for this master budget, specifically the variable cost, are not going to make much sense to compare it to actual because, for example, these variable costs right here for the master budget are based on a volume of 25,000. And remember, variable costs vary with volume. So because this one uses a different volume than the actual result, you cannot really compare actual variable cost to the master budget variable cost. There's your apples to oranges comparison. However, for the flexible budget, it's a good comparison because you're using the same volume with actual. These variable costs right here for the flexible budget, that's using your cost behavior concept. That's basically what you would expect using the same volume if you had actual sales. So your flexible budget is a good comparison with variable cost and fixed cost as well, but the master budget is not. Now, if you look at the master budget's fixed cost, you'll notice that those are basically right in line with everybody else. So you can use the master budget for a fixed cost comparison for performance versus actual, but really the flexible budget is what you want to use. It's got a good comparison with your variable cost, your variable activities, because you're using the same activity level as the actual results. And like I said before, any sort of volume variances between the master budget and the flexible budget, again, it's only, here we go, only because the volume is different. The two volumes are different, and because they're different, that does have impact on your variable cost. So you'll notice in this illustration, if you can compare your flexible budget to the master budget, you can see how you've got the difference in volume right here, the difference in your sales volume. You also therefore have differences in sales revenue because your sales price based on different volume, your revenue is going to be different. And then you can see how here you've got these differences right here in your variable cost because of that different volume. So what I'm basically telling you is these numbers really don't make much sense in terms of a good comparison because you have different volumes. You can't really assess variable cost performance if you're not using the same activity level. And again, like I said before, the flexible budget is really good when you're comparing actual results. It's really effective for your variable cost behavior. It gives you a nice comparison of where you think you should have been. And so again, flexible budget is typically what you want to do. So you'll notice everything here in red when you're comparing the flexible budget to the actual results. You'll notice that you're using the same volume, so that's why that's 0. Notice how in terms of your sales revenue, actual sales revenue was 603,225. Your flexible budget was 574,480. The reason that's favorable is because you're using the same sales volume units. Your flexible budget predicted $20 per case, but for whatever reason, you actually got more revenue. You probably had increased the sales price, so that's why that's favorable. But this is a good comparison because you're using the same activities. The comparison with the flexible budget and the master budget, that's all based on volume. So that's all you can really say in terms of a comparison. This one you can go back and analyze and say, well, why is your actual revenue more than your flexible budget revenue using the same activity? And then you can go back and look at what happened with that sales price. Same thing with your variable cost. Take a look for the actuals. Here's, actually this is what the actual results were happening. This is your flexible budget. Now your flexible budget was basically based on this volume multiplied by these variable costs per unit. So what happens is because you're using the same volume, for example, for sales commissions, flexible budget said 43,086. Well, what actually happened was 45,960. You say unfavorable because again you spent more than you thought you were going to spend on that same activity level. Look at the shipping. Shipping you predicted 57,448 based on 28,724. You only paid 54,578. You put favorable there. Again, same volume. Somehow you were able to lower that shipping price using the same volume. Again, that's a good thing, good comparison. Again, apples to apple comparison. And of course, go down to the fixed costs. Notice how you predicted salaries of 20,000, then you had 21,000 was actual. Of course, that's a $1,000 unfavorable variance. All right. And so again, fixed costs, you can really use any of these. But because once you got this flexible budget set up, notice the flexible budget fixed cost are essentially the same as the master budget fixed cost. So when you're comparing these, you would actually get the same results if you're comparing just the fixed cost. So just to kind of summarize this, again, flexible budget is good comparison to actual, especially it's really good with comparing variable cost behavior. So last couple of things I'll say again, underlying causes of variances. Again, you have this thing called management by exception. That's when you're only looking at large types of variances or differences that could have impact on decisions. And then of course you can use these performance reports that we just showed you to assess operations. And of course, once you start to look at these things, that could then impact your direction of the company.